Welcome to TheoTrade. This is Don Kaufman. Here we are. It's August 23rd, 2017, doing the Theo Night video. S&P futures, with just a few minutes left to the closing bell, are down about 8. You know, looking at the overall market, what has really changed in terms of tone? Well, we're going to look at just that by examining the volatility futures. So, as many of you might be aware, rather than just look at like price the S&Ps, which we could do all day long over here, you know, the S&Ps are going to close at about 24.45, just above a key threshold of 24.38. And we've been talking about 24.38 almost ad nauseum in some of the recent videos that we've done here. And it's actually, I would expect that the S&Ps would have backed into the 24.38 handle, which is exactly where the low was in the session, of course, this morning. And again, I'll highlight this for you here briefly, but you can see the low of today trading right to 24.38 on the button. It would not surprise me to see the S&Ps come back down to 24.38 here, even in the overnight session. With that, let's talk about something a little bit more prevalent. What we're looking at right now on the thinkorswim trading application happens to be a product depth curve of the volatility futures. So lately, we've seen, again, as I said, a kind of a change of tone of the market. Yesterday, a wild bounce to the upside, okay? But we've still got a little bit of volatility on our hands over here with the S&Ps backing off. So what I'm trying to get a feel for is what are volatility products ultimately saying about risk right now? So if I scroll towards the bottom of my screen over here, and I bring up something called the VVIX, okay, the VVIX, and I'll bring up a longer duration chart, of course, on the VVIX. The VVIX spiked all the way into the 135 handle, comes in a little bit. Now, just because the volatility of the volatility index kind of calmed down, that does not per se mean that risk is abated. When you look at this VVIX, I want you to think to yourself, this basically means that everybody right now, that's anybody in the professional world, it's kind of like, I got my hedge on. Listen, they got their hedge on. They were willing to pay up for that hedge in the volatility. If you look at short-term volatility, which is VXST, okay, it's still elevated. The VXV, which happens to be 90-day volatility, it's like a 90-day VIX, it too is elevated out there. But rather than look at those products, we're going to look at the VX futures for what is often termed contango and backwardation. So I'm bringing up the VX futures in the charts. Then I'm cruising over here to product depth. When you get to product depth, you have to switch over to a futures contract, okay? And this is what they call a depth curve. Now, what a depth curve is displaying, and I'm going to go back over to the trade tab here for a second, what the depth curve is displaying is it happens to be displaying risk from one expiration cycle, for example, to the next, and even further out in time. But the way to actually explain this in kind of context here, there's September, here's October. The September volatility is sitting around 13.28. The October volatility is sitting around 13.97. So again, if you wanted to label this, you know, all right, so if we went over here, it'd be like 13.28. Go a little bit further out in time, you're going to jump up to 13.97 over there. Prototypically, when there's no risk, that distance between, again, what we kind of call front and back expirations, the distance typically runs anywhere from 1 point all the way up to about 1.5 points. Okay, so a point to about 1.5 points is much more prototypical. You can see right now we've got less than 70 cents ultimately between it. But when we start looking at the depth chart itself, that's what it's ultimately displaying. The curve, the volatility curve, there is the closing bell. The volatility curve has drastically flattened out, which is an indication ultimately, and again, we're just reading into what the volatility futures are ultimately telling us here. It's an indication of how uncertain even the professionals happen to be in this business right now. And again, if you're curious, you know, I'm going to freeze this depth curve right there for a second. If you're curious, right now, again, the depth curve doesn't look all that serious, right? There's about 70 cents differential over here. Again, that can range anywhere from a point on up to 1.5 points. Again, right in that range is much more prototypical when there's not a lot of volatility. So we're sitting in this big time inflection point. The irony of sitting in the inflection point, okay, we're almost like in this seam of risk over here. And that's according, of course, to the volatility futures. The irony of that, we're also sitting right near in the S&P futures this 2438 handle, which is a big-time gateway to risk. We're seeing a number of products breaking down. And lo and behold, guess what? We have Thursday coming up. And if you guys have missed recent Thursdays, the last 2 Thursdays have meant some rather extreme volatility. Listen, I'm all good with the volatility. We've got to start looking at the volatility products very, very carefully in the days to come. Any more sell-side activity, if there is any more sell-side activity, it's very, very likely that we're going to see these volatility futures start to flip over. And with volatility futures, if you ever look at this depth chart, volatility futures, okay, will ultimately look like this, where short duration risk starts to exceed the longer duration risk. When this occurs, okay, and the vol skew flips over, that means it's on. Risk is here. Risk is prevalent. In fact, specifically what it would say is if you saw the September volatility futures above the October volatility futures, what that specifically would entail is that risk is going to be higher in the present than it is in the future, which is an odd thing to say. Like, how could risk 100 days from now be lower than risk 30 days from now? It almost doesn't even make sense, because in 100 days, the world could blow up. In 30 days, you ultimately see what's, right in front of you. Nevertheless, we're very, very close to those volatility futures starting to flip over. And again, today's close, I think, surprised a lot as we saw some sell-side activity literally into the close on some fairly huge volume out there. Anyway, with that, again, kind of keep your wits about you here in the next couple of trading sessions. We have seen now what has looked like these ugly sell-offs. But again, yesterday's rally looks more like a prototypical bearish bounce. Granted, that is coming from somebody that is a big-time bear right now in markets. Again, markets are right off this key inflection point of 2438. Look for it here in the overnight trade. Look for us possibly to open tomorrow at 2438. Uncertainty is everywhere. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.